Good morning, folks. I hope you've had a great week, and Hiloni and me are back with you to take you through what's been happening. So, Hiloni, was it a weak week or a strong week?
So, Indian markets did see some corrections this week. Nifty corrected 1.2%, while the small and mid cap index both corrected 1.8 and 1.5% respectively. In the emerging market space, South Korea stood out, which was up 4.8% this week. Bitcoin, which was seeing some weakness, has seen some recovery in the last week and was up 2.8%. Again, this week we are seeing a divergence in international markets and in domestic markets in precious metals. Silver, for example, was down 5.2% in INR terms, whereas it was up 4.8% in USD terms.
That's a strange thing, right? So we had the dollar strengthening and silver going up in the US, while the exact reverse happened in India, that silver went down. So why do you think that happened?
So there has been a divergence in terms of premiums in ETFs and in silver. I think what contributes to it is the physical delivery of silver, which is less. So there's a demand supply divergence over there.
So Indian silver prices were running on a premium.
Yes.
And with the slightly risk off or the correction that has happened in silver prices globally, I think the premium is winding down.
Correct. So it was around 15-20% end of Jan. Now it's down to around 6%, but there's still premium in the market.
Okay. So there's so many wheels that are turning within wheels within wheels within wheels. We never know what's impacting. And this time, the last couple of weeks, it's been the premium winding down in general because the sentiment on precious metals has taken a bit of a turn in the short term, though we don't think this is going to hold in the long term given all the things that are happening. And again, coming back to Bitcoin, okay, so as we had spoken a few months ago, Bitcoin is really not proving to be a hedge as it was supposed to be. When there's a risk off sentiment, Bitcoin also falls along with equities and metals and bonds and whatnot, right? So it's not holding up. But the recent statement that the Secretary of State of the US made recently is something we have to take note. And he said China doesn't like Bitcoin. And if China doesn't like Bitcoin, maybe we should be liking Bitcoin. In effect, what he said is that it would do well for the US to support crypto if China, the adversarial country, is not supporting crypto. And yeah, we know China likes gold. The West is going to like crypto, and sometime we are going to see this clash happen. It was surprising that the Secretary of State came out openly and said this. I was taken aback. Okay, and silver divergence happens. And remember, I think it was the last week that we were speaking, the week before last, when silver prices were shooting up way out through the roof on the basis of strong industrial demand. And we did mention that when prices of a commodity go up too much, industry will naturally look for substitution. And I saw an article this week saying that the photovoltaic cells, which contribute about 17% of silver demand, they're looking for a substitute. They don't want to be buying silver and using silver because the prices have gone up too much. It's almost 1/3 the cost for a photovoltaic cell. And they are thinking of going back to copper, which is much cheaper. So if they actually succeed in mixing copper and silver in whatever proportion, or using just copper and keeping conductivity high, then you may see some demand coming down for silver. The industrial demand part of the silver will take a beating. And maybe we will see Kaju Katli coming back with silver foil. Right? So today you walk into a sweet shop, you don't find silver foil and Kaju Katli. That itself is one trauma. And guess what could be the next trauma? Seeing copper on Kaju Katli. All right, so let's deal with it when we have to come to. There's a very interesting quote in the Times of India today, the thought for the day. This one was by Carl Sagan. the astrophysicist, and he just sort of reminds us extinction is the norm and survival is an exception. Nature ensures that extinction happens. And today we are actually living through a very, very disruptive phase, which is the artificial intelligence becoming more and more prevalent. I mean, our papers have been full of AI. I think it's an overkill. I'm almost like up to here with AI. Don't want to be talking too much about it. But yes, let us not forget that we are going through that age of disruption, which we will remember for the next many, many, many years. And the way our lives are going to get upended because of this, we will only see as time flows on. And we have to protect ourselves, we have to be aware of it, be conscious of it, and see how we ring fence ourselves. At the same time, taking advantage of all these lovely tools that are coming up. No? What else has been happening? Any good news?
So there's a good news on the capex front that we have been hearing about. So in the first half of FY26, we saw a 13% growth in fixed assets in the top listed companies in India. To give you a perspective, last year, same time, the growth was just 7.9%. So we are seeing an expansion in those terms, and it also translates into sales. So there's a high utilization as well. So a way to measure this is
sales to fixed assets.
Yes.
Yeah.
So that is 167% currently.
All right.
This same thing was 150% last year.
All right.
So we are seeing a good utilization of those assets as well.
Okay. It does mean that revenue has gone up, which was also reflecting Q3 numbers, that most of the large companies have reported higher top line, possibly spurred on by very good consumption, as we spoke about earlier. And I'm so happy that we are seeing positive numbers on capex growth, because this will have a trickle-down effect on the rest of the economy, especially since the capex growth has been mostly focused on areas like cement, infrastructure, metal and mining, automobile, and so on and so forth, which are large, base industries.
Yeah.
And that's going to help the rest of the economy. But we should be careful not to benchmark capital growth and capital investments with what happened in the earlier years. Okay, the period ending 2013-2014 was characterized by excessive capex.
Okay.
And the next few years, the banking system had to struggle with cleaning up their balance sheets with all the bad credit that happened because of excessive capex. So I think if we go in a very guarded manner now, we should be happy with these kind of numbers. And let's live with it and hope the markets recognize it also. Okay. Apart from all the stuff about AI in the newspapers, there was this article in the Mint. They had a conference recently, and interestingly, there were 3 pain points that were highlighted, or rather 3 questions that trouble investors' minds. And one question that troubled investors' minds was how to pick the best fund. People don't know how to pick the best fund, so a good number of people felt that that was a problem, and many felt that identifying the exit point was a troublesome problem, when to exit. And then another, more than a third of people were troubled by the fact that they didn't know how to pick a fund that suited them. So which fund suits me? So these were the kind of questions that trouble people. And we have our views on that. So let's share our views on these 3 things. So Hiloni, coming to the middle question, what do you think about the problem of when to exit a fund?
I think the question arises when you know that you have made a bad decision. So that's the first thing, that you did something wrong,
okay,
and you want to exit this. I think the other thing is that if you need that money and you are exiting, sure, that is what you have saved up for, you should exit, or else you should stay put and keep investing and let the compounding magic do its job.
Yeah, so ideally stay invested till you need the money, and if you made a wrong decision, well, get out. Okay. The other one was, I think, how to pick the best fund. So in my mind, it's a wrong problem to have. One should not go chasing the best fund, because I've never seen a fund keep the top place forever and ever. So every 1-2 years, the best fund keeps changing, and you only know in hindsight which was the best fund. So it's a mug's game to try and figure out which is the best fund. What we prefer to do is look at a set of funds which have been consistently performing above average. And that's a better way to keep your portfolio performance going, rather than keep chasing for that one best fund, which never happens. Okay, and you'll only keep losing because you keep catching the fund, if you go by the charts, on its down slide. Okay, and you'll keep losing, and you'll wonder what's wrong with your process, because the process itself is wrong. Don't look for the best fund. Look for funds which are consistently there above average over medium to long periods of time. But actually speaking, more than the fund performance, what matters is your asset allocation. So all research shows that it is asset allocation which drives your portfolio returns, and not exactly which scheme in the allocation that you have. So don't worry so much about the nuts and bolts, worry about the bigger picture. How much debt, how much equity, how much large, how much mid, how much small, how much duration, how much yield. So these are the kind of issues you should be working with. Broadly, how much debt, how much equity, rather than trying to chase the best fund. Right? And that's what is our philosophy too.
Yeah, of course. But I have a question here.
Yeah.
Every app that you open today just will show you the best 3 funds to invest in, right? So how does one, tackle that?
Yeah. So it all depends on how you define best. Okay. If you define best by just a fund that has been on top of the chart, then, well, please rewind 2 minutes back and listen to what I said again. Okay, which chasing the best fund is the wrong game. You should look for an app, if you are a do-it-yourself investor, which talks about the process of choosing the best fund. Okay, is there a process? And anywhere in the process, is there a role for consistent performers? Not just saying consistency, are they actually calculating consistency? Like we do. We calculate consistency of performance over long periods of time. Yes. And only then do we get convinced about putting a fund in a portfolio.
Yes. We start 15 years back.
We start 15 years back. Yeah. Okay. And then the last question was?
Which fund suits me?
All right. Actually, it's somewhat of an intelligent question. As to trying to figure out which fund suits me. But again, the more important issue, I think, is how do you build a portfolio that suits you? No one element can be chosen, because you're not going to put all your money into one scheme. It is not recommended in any case. You need to have a portfolio of well thought, rationalized set of funds. So on the whole, you need to ask, does the portfolio suit me? Is it a conservatively built portfolio? Is it a balanced portfolio? Is it an aggressive portfolio? What are my goals? What is my brain wired for? Is it wired to take volatility, or is it not wired to take volatility? And accordingly, you choose the mix of funds that make up your portfolio, and then you monitor the performance of the portfolio as a whole. Is it going up, going down, giving you the required rate of a long-term return, etc. So I guess many of these are wrong questions to begin with. And if you have the problem properly stated, that's half the work done, and you get the answers better.
I think that's how we also do our risk profiling, right? It's a psychometric test.
Correct. We have to pay a lot of attention to our biases, our thinking styles, and trying to figure out what is there in our subconscious which will make us react to danger. How do we react to danger? How do we react to opportunity? And then we should go about trying to build a portfolio. That is the right way to do it, folks. Okay. So if you have any queries, put them in the chat section on the video, and we'll be happy to answer you. Okay. Have a good week. Bye.